I know interest rates have gone up, everybody's scared, they're pulling back, but this is actually a great time to buy a house, and I'm going to tell you why. I know 6 months ago you were really raring to buy a house, you couldn't find anything, but you were all pre-approved. You'd gotten pre-approved for a mortgage at a certain amount because the interest rates were really low. But now the interest rates have gone up and you don't qualify for that same amount anymore. Now that you have to recalculate how much that you can qualify for when you're buying a home, you have to use a mortgage calculator. And on My State MLS, we have a mortgage calculator that anybody can use. You don't have to be a member, you don't have to be logged in. We're going to put the link down in the description, so if you want to use that mortgage calculator, click on it. It's an advanced calculator. It's going to help you calculate your property taxes, your homeowner's insurance, and mortgage insurance if you're going to owe mortgage insurance because you're putting less than 20% down, or by getting an FHA loan, which you'll need to pay mortgage insurance. There are a few options where you won't have to pay mortgage insurance with less than 20% down, and we'll put those down in the description as well. You have to have a general idea of what you can qualify for or what you want to spend on a house, because in order to use the mortgage calculator, you do need a purchase price. So we're going to round that purchase price off to around $500,000 in this example. You also need to know what rate you're going to qualify for. And we're going to look at average rates, both fixed rate and also adjustable rate. And you're going to see how much more you can qualify for if you use that adjustable rate loan. We did a video about this a little while ago on adjustable rate mortgages and how you can still get a rate under 4%. And so we're going to be showing you that you can qualify for more when you use that adjustable rate mortgage. But let's just say you're somebody who's, got a little cold feet, or you're a little scared, or you want to stay in a mortgage for the long term. We will also show you how much you can qualify for if you do want to stick with that 30-year fixed rate mortgage. Let's take a look at current mortgage rates and where you're going to find them. We like to go to bankrate.com, and I also like to go to a local savings bank. So I'm using the Ulster Savings Bank mortgage rates that are on their website because they have some really great ARM rates. And then I'm going to use Bankrate, which uses an average of what the rates are for the week. And you can look up your area and your state, and if you want to pay discount points or not, and you can actually get your real rate from there. We're going to use what Bankrate says is the current average rate for this week, which they say the 30-year fixed is 5.73%, and they say the average 5/1 ARM is 4.21%. Just a little disclaimer, we are not sponsored by Bankrate or the other bank or any bank in this video. We just use these resources because we know of them, we've used them before, but you can use any bank resource that you have. And if you're looking for the rate and you want to find out what the rate is, you're going to want to watch our video called The Truth About Mortgage Rates. This week, the rate is 5.73% on a 30-year fix. That's the average rate that we found on Bankrate. And we found a 3.85% mortgage rate with Ulster Savings Bank. Now we're using the advanced mortgage calculator on My State MLS to calculate how much we can qualify for. We're going to start with a home price of $500,000 because that's just a good round number. And we're going to use a 20% down so that we don't have to worry about mortgage insurance. If you have to worry about mortgage insurance, you can calculate that in if you don't have 20% down. So our loan amount is going to be $400,000, and we said that the average fixed rate mortgage is 5.73% this week. And we're going to do our advanced options. We're going to assume property taxes of about 2%. And homeowners insurance, we'll put it down for about $100 a month. And then you would put your mortgage insurance in, which you don't owe because you put 20% down, and HOA if any, but the house we want to buy, it's not in an HOA. So we're just going to click done. And we're going to see that at a 5-year or a 30-year fixed rate, 5.73% mortgage, our monthly payment with taxes and insurance is $3,262.54. But if we want to do that 5-year ARM that we talked about, we're going to go with 3.85 because that's what we found with the exact same other purchase price. And we get a price of $2,808.56. That's a savings of $454 a month, or $27,000 over the course of the whole 5 years. Now, I'm not advocating that an ARM is for everybody. I'm just going to tell you a little story about what I did. Back in 2006, when the market was super hot and the Fed started raising interest rates, I got a house at a foreclosure auction, and I needed to refinance it and actually pull some cash out of it. But rates were really a lot higher than they had been because the Fed had just raised the rates and they were up around 6 or 7%. I didn't want to take a mortgage rate at 6 or 7%. So the bank offered me a 3-year ARM, and at the time I jumped at it because my rate was in the low 3s. So I was like, okay, good, it's a foreclosure. I'm probably not going to keep it for more than 3 years. So I kept it. But what ended up happening only 2 years later, in 2008, the whole market broke. The Fed broke the market by raising the rate too high. And what happened? The rate came all the way back down to 0. So after the 3 years, my ARM never adjusted because the rates were still at 0. I ended up keeping that house and that mortgage for more than 14 years. And I kept it at that low rate of 3%, which saved me over $67,000 over the entire time that I ended up keeping that house and that loan. So that's my story. But why is an ARM good for you? We're going to show you a chart that goes all the way back to 1955, and it shows you what the Fed does. They let the economy run up with low interest rates, and then as soon as the economy gets too hot, they raise the interest rates, and it only takes like 2 years, 3 years sometimes, and then the economy breaks. And they drop the interest rates all the way back down to 0 again. And you can see this in the chart. So that's why a 3-year ARM or a 5-year ARM can work for a lot of people, because you know that's going to happen. They're doing it now. They're so aggressively raising interest rates. They're doing it to break the economy. Once they break the economy, they're, oh my God, the economy's broken, recession. Let's lower the rates down, and back down they'll go. I told you it was a great time to buy, and it is, because there's a lot less competition out there now. You're going to be able to get a better deal. You're going to be able to find more house for less money. The sellers are going to be willing to deal, and you're still going to get a good rate because you just learned the secrets about adjustable rate mortgages. So if you want to learn more tips about this and how to save money and make money in real estate, you're going to want to like and subscribe to this channel. Hit that like button right now, and we'll keep you posted on everything that there is to know about how to buy a house.